Welcome back, everybody. What we're going to be studying today is we're going to be studying costs and how they behave based on how a related activity changes. So, for example, what we're going to be looking at is do the costs increase if the level of activity increases? Do costs decrease as the level of activity changes? Or do costs stay the same? All right, the three types of costs that we're going to be looking at are variable costs, fixed costs, and mixed costs. So the first one's going to be a variable cost that we're going to look at. And this is a basic variable cost graph, right? Very, very simplistic here. What you're looking at here, though, is you're looking at as a related activity changes. All right, let's pretend this is 0, and let's say we're making something. I think the example we're going to use in a minute is going to be making stereos. So let's say we're making stereos. All right, so as the number of stereos that we make increases, the cost of making those stereos also increases. All right, that makes pretty logical sense, and that's how you would expect most costs to behave. Let's look at the actual example that's given in your slides. Here we have Jason Sound Inc. produces stereo systems. The parts of the stereo systems are purchased from suppliers for $10 a unit, a variable cost. All right, and they're assembled, blah, blah, blah. Cost of direct materials of $5,000 or $30,000. Okay, so what we're doing here is we're making 5,000 stereos, we're making 10,000 stereos, 15,000, etc. Right? The cost for each one of those stereos, the direct materials for that cost, is $10 a piece. All right? So if we're making 5,000 stereos and the direct material cost is $10 a piece, then our total direct materials cost is $50,000. If we have 10,000, we're making 10,000 stereos at $10 a piece, then our direct materials cost $100,000. So you can see here what's happening is as the level of activity changes, the amount of costs goes up proportionately. So now if you want to see that on a graph, here it is, this graph here on the left. What's happening is as the more stereos are being made, the costs are going up proportionally. Okay? So that's the idea with variable costs. Variable costs are costs that change in proportion to changes in the level of activity. So if you're producing more units, there are going to be more direct materials costs. All right. The one thing that doesn't change here is going to be the cost per unit. All right. So each stereo is going to cost you $10, and whether you make one stereo or 30,000 stereos, it's still going to cost you the same amount of $10 a piece, and that's what this unit variable cost graph is here. The costs are not going to change per unit, but the overall cost is going to increase depending on the level of activity increasing. So that's variable costs, all right? Just think to yourself, if I make 0 or 100 of some sort of product that you're making, is the cost going to increase? If that is the case, then you're looking at a variable cost. Now we were talking about direct materials here, but I just want to mention other things that could be variable costs. Something like electricity could also be a variable cost, because the idea is if you are making one product or you are making 10,000 products, your amount of electricity usage is clearly going to change if your product requires lights and heat or air conditioning and electricity in order to make it, okay? So just think of a general factory. If you're making, maybe let's just be more realistic, let's say you're making 100 units of something, and then the following year you're going to make 30,000 units of something, clearly the level of activity has changed your cost, making electricity a good example of a variable cost as well. Now let's look at our next type of cost behavior, which is a fixed cost. A fixed cost does not change based on the level of activity. All right, so whether you make 0 product or whether you make 10 products or 30,000 products, the cost is going to remain the same. All right, so a fixed cost graph is going to look something like this. Get my line. All right. Here's your level of activity. Let's say you're making 0 units, 100 units, all the way up to 30,000 units. Whether you make 100 or 30,000, the actual cost, which I'm putting here, is going to stay the same. So they say that's the dollars. All right, and that's this here is the number of units, and that goes for the variable cost graph as well. I'm just lazy and I don't want to write it again, but you get the idea. Sorry, number of units. All right, so what you're looking at here, an example of a fixed cost might be something like the property taxes you pay on the building. Property taxes are not going to increase whether you make 10 products or 30,000 products. All right? Regardless, fixed costs stay the same. Another example of that might be, and this is the example you're going to see in your PowerPoint in a second, another example of fixed cost might be the supervisor of the factory's salary. So let's just say you have a supervisor of the salary, a supervisor of a factory, and that person makes $100,000 a year. Now, whether the factory produces 1,000 units or 10,000 units of a product, that supervisor is still going to make $100,000 a year. That's not going to change based on the level of activity in the business. Now, we're not talking about bonuses for anything. We're just keeping it simple. We're saying whether they make 10,000 units or rather, whether they make 1,000 units or 10,000 units of something, the salary stays the same of the plant supervisor. So that's another example of a fixed cost. And as I said, I believe it is here. All right, so the example the book uses is Minton Inc. manufactures bottles and distributes perfume. The production supervisor is Jane Sovisi. She's paid $75,000 a year. The plant produces from $50,000 to $300,000 of perfume a year. Now here's what we're saying. Whether 50,000 gets produced or 300,000 bottles gets produced, she's still going to earn $75,000 a year. So with that, your fixed cost graph is going to look like this. No matter what, she's making her $75,000 a year. All right. Now, the unit fixed cost graph is more interesting here. All right. What we're saying here is if the factory, if you look at these numbers here, here's the 50 to 300,000 bottles of perfume that are being produced. Let's say we're dividing the factory supervisor's salary, the $75,000, over how many bottles of perfume get produced. Okay, so this is where it's a little bit interesting. Here's the chart for this. All right, no matter what, she's making her $75,000 a year. But let's say the factory produces 50,000 bottles of perfume. Well, at 50,000 bottles of perfume at $75,000, what you're going to say is you're going to say each bottle of perfume basically had $1.50 worth of fixed cost in it that is related to the supervisor's salary. All right, that's 75,000 divided by 50,000 bottles. Now let's just say that the perfume, there was 300,000 bottles of perfume made in the year. Well, now you might say to yourself, okay, well, she made $75,000 a year, made 300,000 bottles of perfume, so that equates to 25 cents a bottle. All right, so the more you spread out a fixed cost over the number of units you're producing, the cost per unit goes down. All right, so what that looks like in a graph is this graph here on the right. All right, the unit fixed cost goes down as the number of units increases. You may have to read the book on this one to really get your head wrapped around it. And this is a nice summary slide of those two items. All right, the fixed, no matter what, she makes $75,000 regardless of how many units are being produced. But if you decide, if you're trying to capture how much fixed cost is contained in each bottle of perfume, you're spreading those costs over the number of perfume bottles that you're making. You can see the costs go down as you make more and more perfume bottles. All right, so the third category we're going to look at is we're going to look at mixed costs. And mixed cost looks something like this. Okay, so I spared you watching me draw this. Mixed cost looks something like this. The idea is that mixed costs have a component of variable cost and a component of fixed cost in it as well. All right, an example that you might think of here could be if you were to say a car lease, for example. Let's say that you pay a normal lease amount for the car every single month, right? The same amount changes, it doesn't change no matter what. But maybe you hit the end of that lease, and for every mile that you drive over whatever the number is, let's say 100,000 miles, now you have to pay 30 cents a mile for every mile over 100,000 miles. So initially it was a fixed cost, right? The lease payment was exactly the same no matter what. But once you hit that 100,000 mile mark, now you have a variable cost component as well, because the costs are going to increase based on the miles that you've driven. Right? So the example given to you in your slides is Samson Inc. manufacturers sales using rented equipment. The rental charges are $15,000 per year. So there's your fixed component. No matter how many you make, it's $15,000 a year. $15,000 a year. That is your fixed cost. Is the rental charges. But as soon as you hit more than 10,000 hours, you have to pay $1 for every hour the machine is operating. So it's got a component of fixed and a component of variable costs. And what that's going to look like is this right here. Okay? All right.